Strong US jobs data adds to the case for a Fed hold. Lower EU inflation supports an ECB rate cut this week. Australia's Q1 GDP is set to be weaker on falling public demand. And RBA minutes reveal just how much a 50 basis point cut was discussed in May. That's coming up in our 5 Things in 5 Minutes on Wednesday, June the 4th. And then in the second of 2 deep dive interviews into Australia's agriculture commodity outlook, ANZ Commercial's head of agribusiness, Mark Bennett, highlights the challenges and opportunities for Australia's sheep, dairy and cropping farmers.
Most of our milk is produced in the southern states, in Victoria namely, and Tasmania. And where it's been dry, there's a cost in finding feed, water, you've still got high labour costs.
But first, in 5 and 5 with ANZ. I'm Alex Tarrant in for Bernett. There was contrasting data across Europe and the US overnight. EU inflation fell sharply in May to 1.9%, which ANZ research says will support the ECB to cut rates 25 basis points later this week. In the US, job openings data was stronger than expected in April, a month dominated by tariff uncertainty. ANZ economist Bansi Madhavani says that points to the FOMC holding rates later this month.
The pace of hiring also increased, reaching the highest level in a year. That's a sign that demand for labor was relatively healthy in a month when reciprocal tariffs were announced at the start. There's also a slight rise in layoffs and fewer workers quit their job voluntarily. In that sense, there were some soft spots in the data. But overall, the data were healthy, and such data are consistent with our view that the Fed will continue to prioritize inflation while awaiting trade policy certainty.
At 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.6%. The 10-year US Treasury yield was flat at 4.460%. Gold was down 0.6% at $3,377 an ounce. West Texas Intermediate futures were up another 1.7% at $63.58 a barrel. The US dollar index was up 0.5%, with the Aussie down 0.54% at 64.64 US cents. The Kiwi was down 0.55% at 60.01 US cents. Number 2, ANZ Research has lowered its Australian Q1 GDP forecast to just 0.2%, following the last partial indicators out yesterday. Falls in public sector demand, government investment, net exports and company profits are set to lead the weakness. Here's ANZ senior economist Adelaide Timbrell.
We expect to see really weak household consumption in Q1, which means consumers were likely to have saved more than spent their extra income over the quarter. That's 0.2% of household income, along with the fall in public demand and net exports. It will be cushioned a little by business investment, which we think was up around 1%. That won't be enough for a strong GDP growth in Q1. We think this 0.2% growth will be the weakest of 2025.
Number 3, Reserve Bank of Australia board minutes out yesterday revealed just how much a 50 basis point rate cut was considered in May. ANZ head of Australian economics, Adam Boyton, says there was a lot more space devoted to the case for the eventual 25-point cut. Adam continues to expect 2 further cuts in August and February.
The decision to cut 25 instead of 50 wasn't described as a judgment call or an on-balance decision, but was simply described as the stronger one. And so both the length of the discussion around the 25 versus the 50, and also the decision to cut 25 instead of 50 or the case to do that was described as the stronger one, suggests to me that it wasn't a line ball decision in front of the board. The other thing is that when they did talk about a 50 basis point reduction, it didn't necessarily imply a lower cash rate over the entire period ahead, but rather getting to the same point a bit sooner.
Number 4, ANZ Roy Morgan Australian consumer confidence fell again slightly last week by 0.6 points to 86.4 on reduced confidence in financial conditions over the next year. ANZ economist Sophia Angala says, however, that RBA rate cuts are starting to show through in the survey.
Confidence across the housing cohorts has converged. Confidence of outright homeowners has fallen, while mortgage holder confidence has likely risen due to those RBA rate cuts in February and May flowing through to household disposable income. So now we're seeing that confidence of outright homeowners and mortgage holder confidence are hovering around the same level, and mortgage holder confidence is now at its highest level since May of 2022.
Number 5. New Zealand's terms of trade improved 1.9% in the March quarter as export price growth of 7.1% outstripped import prices at 5.1%. ANZ economist Matthew Galt says export prices were stronger across a range of categories, including dairy, meat and wool.
Partly it's related to weakness in supply of dairy and meat products from other countries in the Northern Hemisphere, where they've had issues like disease in their livestock over the last season. So we wouldn't necessarily expect those high prices to persist as other countries are able to ramp up supply in response to those high prices. So we might expect a bit of a pullback, but it's certainly good going for now.
Matthew Galt there. Now in our deep dive interview, ANZ Commercial's head of agribusiness, Mark Bennett, discusses the outlook for Australia's sheep, dairy and crop farmers. I started by asking Mark how Australia's sheep farmers had fared during recent weather events compared to cattle farmers.
The difference really is that the sheep market, most of our sheep are in the south, whereas most of the cattle are in the north. And so we've got the seasonal conditions impacting where most of our sheep are. So that's a real supply pressure, and you don't have the northern market buyer that we have in cattle really assisting that market. So a lot of sheep are going out earlier than they would at the moment simply because the southern market can't hold them. There are record sales going through the yards as we speak. How lasting that is, we'll see. But there's still this underlying export demand, particularly in the mutton trade, where farmers are able to quit stock at decent prices as they go into those markets like China, Malaysia and into the Middle East, in addition to lamb to a degree. But this red protein is seen as a partial replacement to perhaps an expensive beef product into some of these markets as well. We're still a big seller of lamb into the US market, where again, they're challenged by supply. They run a much smaller flock. So prices are holding up really well for sheep.
And now dairy farmers will be waiting on their prices for next season. What's your forecast for the next season for Australian dairy?
They are waiting sort of anxiously, and we're just going into that opening round of posturing, I guess, of potential opening prices from the key processors. We've seen a start of that already. It's eagerly anticipated always, but particularly at the minute where dairy farmers are facing real cost pressures on farm. Again, most of our milk is produced in the southern states, in Victoria, namely, and Tasmania. And where it's been dry, there's a cost in finding feed, water. You've still got high labour costs. Farmers are, by and large, looking for a milk price that's sort of certainly $9 plus, but some would argue $9.50 plus in order for them to be able to be above cost of production in producing the milk that the market would look for. Our consumption of dairy is relatively steady here in Australia. We do have some very strong markets into Japan and into China, but we probably have, and while conditions and pricing conditions are better today than they were this time last year, which points to a better price, Aussie dollar may be a benefiting factor there as well. We've still got potential supply coming in from the likes of the EU and the US, bit of dampening demand in China. I guess the processors won't want to quote an early price for next year with a view that they can't go back on that price throughout the season, but they also need to quote a price that encourages the farmers to supply. So we'll have to wait and see where that takes us to July 1.
And there's been an oversupply in global grain markets. So how are cropping regions and those farmers reacting to what they're seeing with global prices?
Our cropping sector has continued to produce really strongly, notwithstanding the pockets that have been challenged by rainfall. So we had a really big rebound in New South Wales crop last year, strong crop out of Western Australia, difficult times in South Australia, Victoria and southern New South Wales, and a good year in Queensland. Global production is strong and stocks are high, but ex-China, the stock-to-use ratio is under a little bit of pressure potentially. The season could be a little bit late to see as much canola go in, but wheat and pulses in particular, lentils and chickpeas, still look like a really good and well-priced product, notwithstanding smaller tariffs coming back into play in the key market of India. But it's really about the break. Some crops in and up, other landscapes are really planted dry and waiting for rain, and the less crop we're likely to produce would support commodity prices going up as well. So a tale of two halves.
Mark Bennett there. I'm Alex Tarrant in for Bernett Hickey. That was 5 and 5 with ANZ for Wednesday, June the 4th. Catch you tomorrow with analysis of Australia's Q1 GDP data out later today.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.